Welcome, John, to Wealth Matters podcast. How are you doing, sir?
Terrific. Thank you. Thanks for having me.
No, much appreciated. I know you're a busy man. You just had launched the book, so I'm pretty sure you're going through lots of interviews. So I appreciate you taking time out of your busy schedule.
My pleasure.
So, John, can you tell us about what's your primary job or business?
Well, today it is private equity, almost all exclusively real estate investments. And we do acquisitions, but lately it's mostly ground up developments.
Oh, awesome. Ground of development. How did you jump into ground of development?
Well, I did it in 2000, I would say 3 through about 2006.
Okay.
And then it kind of became, it looked like impossible to do ground up development, but that's okay. And then we ended up doing acquisitions for a long time, probably 2000, I guess 9 until around 15 or 16 when those started to dry up. And then we started selectively, very carefully doing development deals again.
I see. So how do you see development being different from just acquisitions where you have everything ready to go? So my understanding is development means you don't get paid, or the investors don't get paid right away for some time, right? But in the long haul, it pays up, right?
Yeah. I mean, there's a little more speculation involved. I think there's a little bit more work involved trying to quantify the markets, the supply and demand issues that are out there, the costs, especially when you're going to build. I believe you have to put in quite a few layers of protection, we call it, pad it with reserves and extra fees, and then try to present something to the investors that will get them excited about investing, but is not necessarily what the deal might do on its best day. So we try and present the numbers very conservatively. And then if we hit them, we're heroes. And most of the time we tend to exceed that, which makes it even better.
Got it. So when and how did you start in real estate?
I started over 20 years ago.
Wow.
As I just had graduated from school. I actually started out working for a developer as an on-site sales agent in a golf course community. So I toured people around in a golf cart, and my hours were about 1 to 6 p.m., 1 p.m. to 6 p.m.
Oh, so wow.
Sit in a model where not a whole lot of people came through really, but and then I'd play golf in the evenings and in the mornings. And after about 1.5 years of that, I had sold enough product so that they would not be able to build anything for about 2 years. I think I had a backlog of about 50 condos sold. And so I decided it was time to venture out, and I got my residential real estate license, and I started selling residential real estate, mostly converting for sale by owners into listings, and expired listings that other agents didn't sell. I would convert those into listings and get those sold. And so I did that for about 7 years, selling around 100 to 120 homes a year. And then, and in the meantime, throughout that process, got my CCIM designation.
Oh, okay.
And started doing some smaller land splits and development deals on my own. I didn't have a lot of money. I started at zero essentially. So I had, I was making good money, but obviously to make an income, pay taxes, save money is very, very difficult. I knew that all along. And so the goal was always to have my own real estate portfolio, which I built by buying single family homes. I had about 20 single family homes by the end of the 90s. And
nice.
And so then the deal started getting bigger. The economy of scale you can get on larger portfolios, rental properties, apartment complexes, commercial buildings, you get better returns there. But I didn't have all the money. So in 2005, when we bought a student housing portfolio in South Bend, Indiana, that
Okay.
housed about 480 Notre Dame students.
Wow.
That
That's
was the
big.
first time I ever opened it to investors. So I
Oh,
needed
okay.
about $2 million. I put in 300 grand. My business partner down there who ran the portfolio put in 300 grand, and we raised the other 1.4 million from about 7 different people in total. And we sold that a couple of years later and doubled everybody's money. So that was very exciting, and everyone was thrilled with that outcome. Then, of course, the markets froze up, and we waited. And in 2009, I did my first acquisition in a fund structure, which we had 11 investors in,
Okay.
and that ended up growing to just over 300 investors by the end of
Wow,
2000.
that's huge. So you started raising capital way before a lot of these people who are raising capital now, including me.
Yeah, it's it took a long time. I mean,
Yeah.
but it also went by very, very quickly. And
Right.
the growth was amazing. It was almost all word of mouth. We didn't really do any advertising. Of course, now with the book out and with the various podcasts we're on, we get people signing up for our potential investor. I think we have maybe 10,000 on the potential investor list, and around maybe 400 accredited investors that are actively participating in various projects we have going.
So I want to talk about the book. So as I mentioned, John has just recently launched the book, Do the Work Once, Get Paid Forever, How Smart People Invest in Real Estate. So what is the premise of this book?
So originally, when I used to use that term, do the work once, get paid forever, what I was referring to was the idea of buying some rental real estate, and you've done that work, and then you collect rent and get paid forever. Well, of course, there's a management headache to that, and that's
Right.
also it's also a lot easier said than done.
Yeah, and I call it as active investing, even though turnkey
It is.
providers and whatnot, they'll say passively collect, passively whatnot. That's how I started, but it is still a lot of work, even when you have a property manager managing the property.
Yeah, and I think it's a little more difficult to screw up, than maybe investing in a startup company or something. But it's kind of like trying to find someone who can pick stocks. It's
Right.
not easy, and I really don't recommend people do it themselves. So now what it means and what the book is all about is it's really about finding people who do what we do. I call them deal sponsors or syndicators. People out there that have projects ready to go, that know what they're doing, that have the ability to allow investors into their deals to get them funded. So by doing the work once, what you're really doing is you're identifying people that have investment opportunities for you, that have a track record, that know what they're doing, and then you participate with them, and explains how to find those people. It explains why they don't come find you all the time, and it also explains the right questions to ask somebody like that. It outlines what a PPM is, a subscription agreement, what an accredited investor
I
is, what
see.
these things mean. It's really more educational, and it should be a quick read. I think in a couple hours you can have a very good understanding of how our world works, what we do, and hopefully a leg up on your average professional, doctor, small business owner, or whatever you may be, where you want to find real estate opportunities and invest in them. Ideally, this book gives you a leg up on how to find those people,
I see.
how to vet those deals, and how to get involved in them.
So, can you please then share the process of evaluating a deal sponsor or syndicator in detail?
Yeah, I mean, I can give you a few things from
Sure.
the book. I mean, it would take a while to go through the whole thing, but
Right.
a lot of it's common sense, but a lot of it isn't. I mean, I think to a certain extent, you're trying to gauge someone's character. So I go right to, so the whole reason, backing up a step, as to why I actually wrote the book is I
Mhm.
had this conversation with investors hundreds and hundreds of times. Anytime someone's brand new to us, comes off our potential investor list and raises their hand and says, "Hey, I'm really interested in this deal. I'd like to, talk to you about it." I'm happy to jump on a call and speak to them about it. And 9 times out of 10, they're really focused on the deal itself. Oh,
Right.
I see this one you have in Denver. I hear Denver's booming.
Yeah.
I want to get in on this one in Denver. You can't go wrong in Denver. And I sort of scratch my head and say, well, yeah, actually you can, and a lot of people are.
Yeah, and just to add to that, even when I started, I was always focused on the deal, right?
Yeah.
Of course, the more I learned, and after hanging out with people like you, I realized that I should be focusing more on the syndicator first, that track record, and then look at location, deal, etc., the numbers. Because after I lost money in my very first syndication deal, where I had put money in Vegas. Vegas was booming a couple of years ago. Vegas, like, you can't go wrong. Vegas student housing, and as of now, after a couple of years, I haven't got paid, and I'm not sure if I'll get my principal back. So,
Well, and that's how I learned. I was in, I think, 7 or 8 different deals that my former mentor had put together. I think I had $450,000 total put into those deals, and most of them didn't work out.
oh
Um,
wow,
some of them I got some money back on. Some of them were total losses. But it was, it was a fairly expensive lesson. Although I will say it was
yes.
probably cheaper than graduate school. So um, as far, so I looked at it as an educational process, and I'm still
Right,
grateful for it because I wouldn't, I mean, today I
right.
put a deal together and make $1 million on one deal. So, um, but more importantly, I think I learned the right way to put in safeguards to protect investor equity, because we're first and foremost about not losing money.
Yes.
That's like our main
That's
focus.
the investment 101, right?
Yeah. And you know
You
how
want to make
easy it
sure.
is as a deal sponsor developer. I mean, you start messing with the numbers, you're just trying to make it look better and better and better because
Right,
you think that's what's going to attract capital. And
correct.
so there's this real challenge there, but we're digressing a little. I would say, the character. So these conversations I was having, this book is meant to have these conversations, which is, hey, you're concerned about, or you're asking questions about the specific deal. Let's say it's in Denver, and I might talk to 10 people about that deal, and all of those 10 people might have one question or one concern. And if I can address that, they want to do the deal. And guess what? No two of those are the same.
Right,
So by definition, none of them are right, and all of them are right. Yeah, any one of those things could go wrong. Yes, we could have a weird location. Yes, we could be under projecting our numbers, but those really aren't the questions they should be asking. Those really aren't the things they should be focused on, because I'm not here setting up to do a deal that doesn't work, because if I do, I don't get paid. I
right.
don't need a resume. I don't need a track record. I already have it. I have plenty of investors. So there's no reason I'm going to ship out a deal just to do a deal. I don't need to. I'm financially don't need to work another day in my life. And so early on in my career, that would be a different conversation, because I needed the money and I needed to do the deal to stay in business. Today, I don't need that. I mean, we own a real estate portfolio. We have gobs of things going on. It's like financial motivations cease to be terribly important to me. So
Right.
so the questions I put in the book for people to ask about someone like myself is, why do you do what you do? What motivates you to do this? What are some of the challenges you've encountered in your projects that you didn't see up front, and how did you deal with those? What are things that could have completely derailed a project, and how did you solve that? These are, because everybody knows, I mean, and everybody that
Yeah.
does what we do knows that when you set out to do a deal, it never goes from A to Z
Oh yeah.
without a bunch of W's and
Right.
threes and eights jumping into the equation
Exactly.
that weren't supposed to be there.
Yeah.
So,
Otherwise, everyone would want to be a deal sponsor or,
right.
operator, right?
So it honestly puts the investor in a strange position because you really want someone who I would describe not necessarily as slippery, but as nimble and
Right.
has the ability to speak out of both sides of their mouth in a way in order to overcome issues and things that come up on the deal. But you also don't want, it's difficult because when I'm talking to an investor, I don't want to come off as salesman. Like, oh, you need to be in this deal,
Right.
blah, blah, blah.
Yeah.
So we don't apply any pressure
Yeah.
to
You don't want
investors.
to ever push any of the investors, right?
No, and you really don't want people putting money in deals that they shouldn't be putting in deal. That's the other thing we've been very careful about, and we explain in the book as well. Is I don't care how comfortable you are or how much of a home run you think a deal is. Start small, get
Yes.
comfortable, and keep diversified and keep going. Because I mean, if you really think about it, on average, we're looking to generate 15 to 18% returns for our investors. Some
Uh-huh.
might be in the 12 to 15 range. Just depends on the deal and
Right.
what we think the risks are that we're taking.
Right.
And so we're looking for a pretty safe, let's say 12 to 15% annual rate of return. Well, if you do that with $100,000 on 3 different deals, and then on the fourth one, it goes to zero,
Right.
what was the point? The whole exercise, you should just put the money under your mattress, right?
Right.
So you have to be, very good, very consistent, and have literally a 90% success rate, in my opinion, in order to achieve your desired outcome for your investors.
So yeah, and I'm glad that you brought up start small. That's the key, as well as diversify, right? Diversify amongst assets and the location. I mean the deals, right? Because that's gonna give you diversification from uh, different markets as well, right? So as you and I know that real estate markets don't work in tandem. It's not like stock market where the entire market goes down. When something happens in UK, even US stock market will struggle. But we all know that when California market went down over 60-70%, East Coast market wasn't even affected, and now East Coast is struggling to get back up, whereas California is more than double, tripled, right? So by diversifying amongst assets and the location, of course, you can reduce the risk as well as, of course, cap some rewards too.
Well, and I think you have to be nimble, right? I mean, you have got
Right.
to be nimble and have the ability to move around and look at different markets. I mean, certain communities, certain towns get hot and they're
Yes.
good for a window, and
Uh-huh.
then all the money floods in, and then the next thing you know, they're
That's it.
overbuilt.
Once
So
the institutional money comes in, you're done. Why
yeah,
you got to get out? So,
that's right.
so what would you recommend someone, a newbie or a first timer who is trying to dabble into, syndicated investments? What should they focus on as soon as, let's say, speak with you or I or someone, and what should they focus on right away when they're speaking to a syndicator or deal operator?
Well, I think you're going to get an overall flavor, and you probably don't even need to buy the book. You can probably do one of those things where you get a sample of it on Amazon and pick the chapter on, the questions to ask, people that do what we do, if that's, whatever. But you're trying to get a flavor of, obviously, what's the philosophy, what's the outlook, and what's the motivation, and what's going to keep this person attached to the deal. But I, generally speaking, believe that location is obviously, it's a cliche. Location, location, location. Those are the two most important things in real estate.
Right.
But location is very important. I mean, the contractor is exceedingly important. So,
Oh, yes.
does the underlying contractor have a gross maximum price on their bid? Is it bonded? Are they
Yeah, yeah.
insured? Are they reputable? We used to try. I've always been in the camp of trying to save money, get things done cheaper. Kind of nickel dime things, whatever. I have completely 180'd on that and go and to the philosophy of pay for quality and pay to get things done on time. and that served us very, very well. So, we spend a little more money up front in the planning phase. We spend a little, we might not go with the cheapest GC out there. However, we're buying insurance. It's like added insurance that the
Right.
deal's going to happen. And then they're going to stick with us if there's an issue that pops up, and they're going to resolve it fairly. And,
That's the key.
get it taken care
Especially
of.
when you are doing, big rehab or development, right?
Yeah.
So no, that this is very, very helpful. Let's take a quick break, and when we get back, we'll talk about some of the lessons you have learned so far.
All right.
Welcome back to Wealth Matters Podcast. I'm chatting with John, who is the author of Do the Work Once, Get Paid Forever, How Smart People Invest in Real Estate. And of course, listening to John for last 20 minutes even, I highly recommend buying the book. So I want to ask him, someone who has been in the industry for 20 plus years, I'm pretty sure you have made some mistakes, right? So what kind of mistakes have you made, and what did you learn from those mistakes?
Well, I've made, I don't make mistakes. I mean,
we don't, right?
Other people make mistakes, and then I got to go fix them. But no,
but you pay for education. Let's not call them as mistakes.
I have certainly, what the mistake I tend to make and I tend to repeat is one of thinking that I'm going to be able to manage something. I know the problem or the challenge is going to be there throughout the deal, and I think I'm going to be able to manage it somehow and handle it, and I don't end up being able to do that. So, for example, you might take hiring a contractor that maybe is slightly less reputable than others, but you think to yourself, well, I'm going to be able to run them right and keep them on task and, make things happen according to plan. And then the next thing you know, you're, a couple $1 million over budget and a year longer to get done with the project. And there's nothing I can really do about it. As much as I try, I can't, do that. Or you do a development in a community, like I don't mind throwing this example out there. I live in Ann Arbor, Michigan, and I tried doing development here, a number of years ago. And I got all the way through planning commission with glowing remarks, but we have a political process here, and city council turned the project down. So, and for no good reason other than, the neighbors.
Sometimes you can't, control. You can't do much.
Right. There's nothing to do. And so that cost me, some money, a lot of time and energy.
That's the key, right? The time and energy.
Yeah.
More than money.
Dollars are today irrelevant, but the time and energy, and, but it also, I gain a lot of experience, right? Okay. So I said, well, I'll never do that again. Well, now we have a condo project in Ann Arbor, and sure enough, it's taking a year longer, and we have cost overruns, and it's entirely the fault of the city of Ann Arbor. Their process for getting approvals and developments done is so archaic. It's so antiquated. It is difficult to explain how ridiculous it is. The elevator inspection took us a month. It's incredible. And I understand everybody's busy. I understand that, blah, 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 but we experienced this in no other communities that we're in.
That's
zero.
Interesting.
And we're in Denver, Nashville, Washington, D.C., Sarasota, Florida. We are all over, and we do not have this problem anywhere, but we have it here. And my understanding is we'd have it if we were in Boulder, Colorado, and so we wouldn't do anything there either.
I see.
But, so we just, those are the mistakes that I'll make, are things like that. But I'm learning, and I tend to not make the same mistake twice.
That's the key.
So, unfortunately, we're done with Ann Arbor, and we have one other project that we're going to try and get entitled here, and then once we're done with that. But everything we're into now is going into places that want us there. There's just
Right.
there's no point in going into and battling an uphill battle. You
Yeah.
just can't
Yeah.
do it. So
It's
I've experienced other issues that, we had an apartment complex I bought in 2007 at the height of the market.
yeah.
And, so that one did not perform for the first year and a half that I had it. I was anticipating being able to distribute at a 6% rate right from the get-go. The credit markets froze.
Right.
Our interest rate went up 1.5 within the last week before closing, just because the yield spread widened. And, if you didn't watch the movie about all the CMBS market,
Oh
whatever.
yes, I did. Yeah,
Yeah.
The Big Short.
Yeah. So we were
It's a
stuck
great
right.
movie.
Yeah, we were stuck right in the middle of that. And I should have just punted and walked away, but we closed on the property. And so the good story is we got a good manager in there. We got the place full. We fixed all the issues. We got the rents up where they needed to be. We rolled up our sleeves. We solved the problems. And at the end of the day, it hit projections as planned. It was very, very stressful for about the first 6 months to a year. And I like to say that 1 year cost me 5. And
Yeah.
that's why.
But that's amazing, though. Even then, you were able to hit the target.
Yep.
So,
And so, yeah, it worked out. And we've run into all kinds of issues like that on various projects, but those are things that they're not necessarily mistakes. They're just issues that pop up, and we got to find a way to.
And you just have to learn from those issues.
Yep,
or
absolutely. Anyway.
So any business, finance, or personal development book do you recommend?
Oh yeah, I'm always reading something. I mean,
me too. That's why I always asked.
Yeah, I think, right now I'm reading, and my wife's always rolling her eyes because I'm reading things like The Very, Very Rich and How They Got That Way.
I haven't read that one.
It's written in like 1970 or something.
That's an old book. Huh?
But everything's still applicable in it. And I find it to be, I find older books like Think and Grow Rich.
Think and Grow Rich is amazing. Yeah. The Alchemist.
Yeah. I read that. Even things like the Rich Dad, Poor Dad book series, I get things out of those. As a matter of fact, I built a business plan by basically buying that game Cash Flow Quadrant.
Cash Flow Quadrant, great game.
Robert Kiyosaki came up with. I took the scorecard from that game, put it into an Excel spreadsheet, and that's now I have a 5-page business plan that I send to a lot of younger people that are graduating that don't know what to do with themselves. All my staff. I've taken people that have come out of school with over $100,000 of student debt, put this plan together for them. They focus on it. They look at it. They start trying to change the metrics of the scorecard, focus on creating passive income, getting out of the rat race.
Wow.
And it's amazing. I mean,
I'll have to look at that. But this is the crux of the podcast. Listeners, listen to this. This is amazing.
I'll send you a copy. It's great. I mean, it's because it's simple, and I refer to it all the time, and I update the numbers, and it doesn't. But I saved a copy of this thing from way back when I started using it. And I had a zero net worth, and I remember I just wanted to be a millionaire by age 31. That was my big goal, and I put it in this plan, and I started buying these houses and doing all this stuff, and so on paper, in 2001, I looked pretty good. It looked like I was worth $1 million. But then, of course, by like 2008, it looked like I was worth half that. But, so it's all irrelevant.
But it's a great book, and the game as well is amazing. I love the game.
And so there's those kinds of things. I like the Ayn Rand novels. I mean, again, old books. And let's see, what else do I have right now on my bedside table? I'm trying to think of that I've read. Oh, I will tell you one book that's not necessarily business related or real estate related, and it's called This Naked Truth. And it's actually a book more about drinking alcohol, how it affects your system, how your mind responds to it, dopamine levels, various things like
I'll
that.
have to read that book. So I don't drink. I have never
Well,
drank. So that's why it would be good for me to read and talk
well,
about.
yeah, I think it's more for people who drink more and
Right, of
want to
course.
potentially drink less, which I put myself in the category of social drinking, but
Right.
as it basically talks about how if you do drink, which happens to a lot of people in college, just like everybody else, I was
Right.
a college partier guy. And
Binge
so,
drinking.
but over time, that you tend to drink more and more and more because of
Right.
your brain secreting more dopamine, which gets rid of the drunk feeling. And it was just, I found it extremely educational, and it
Interesting.
immediately changed how I looked at alcohol in general, the whole world. I mean, I didn't think it was possible not to drink. I especially in my
Right.
social circle. And now
Right.
I can routinely go out and have I have what I call a third, and it's 1/3 tonic, 1/3 soda, 1/3 cranberry, and it looks like a cocktail, and I can pretend like and it's fine. But you have to do this in certain social circles because
Right.
other people will feel uncomfortable. I don't
Right.
feel uncomfortable, but they'll feel
Right.
uncomfortable. So anyway, I thought it was a fascinating book.
I'm the sparkling water drinker in my
Yeah.
circle.
Well,
I just
there
have
you
to
go.
get a sparkling water every time.
And maybe you don't read the book because now who knows? You'll have the opposite effect on you.
That's funny.
Anyway.
So, the last question: any advice you can give to newbie investors or just beginners who may have one single family?
Yeah. You've asked a lot of questions on this podcast that I don't get on most podcasts I'm on.
Oh, okay.
Great, and it's
Thank
awesome.
you.
I do get this one a lot, and I tend to answer it the same way. What I did when I started out, and I'm not a typical mindset of, I wasn't really a book learner. I wasn't really into the school aspect of things other than, I hated it actually, because I was more of an ADD type mindset
Oh,
and just
wow.
couldn't sit still in a classroom, and they didn't really know what that was back then. So
Right.
nobody knew how to deal with me. So I learn more vocationally by kind of doing things. And what I always tell people, especially people coming out of school today, is look, you don't really know anything. You think you do, you don't, you have no idea. And what you have to do is you have to go find something where you can get paid, but more importantly, where you'll learn. Where you'll
Right.
learn a skill. Like,
That's
I
the
don't
key.
care if you're selling Cutco knives,
Uh-huh.
I sold newspapers. They don't have those anymore. I sold real estate. I sold credit card authorization machines.
Oh, wow.
I wanted to learn how to
Right.
sell. And the reason I wanted to learn how to sell was I thought it was like a magical skill. I was like, if I could learn how to sell ice to an Eskimo, then
Yeah.
I could learn how to find the woman of my dreams. And
You can learn anything, right? That's what I have figured out.
Anything.
If
And
you
the
learn how
best
to sell.
sales guys always have the best wives and the best looking women. So I learned how to sell, and then I got lucky and got in a lot of situations where I could apply that skill to very good things. And the other thing I say is to find a way to create value. Like, if you can focus on the value equation, don't try and selling isn't about convincing somebody that they need something that they don't need. That's not
Right.
sales. Sales is about creating value for someone or
Right.
having something and finding someone who needs that. So it's more of just a numbers game, if you have like a product, let's say. But more importantly, like in real estate, I used to sell real estate and make commissions. And I felt like, hey, I'm doing a good job. I'm getting these people's house sold. But I'm also, I'm not putting any money in their pocket necessarily. Maybe I'm getting them a few $1,000s more than the next guy. That's always the argument. I'm the better
Right.
agent. I can get you more money. But the reality is there's a market, and, I don't know that you can really do that much more than the next guy. In certain situations you can, if you have multiple offers and you know how to handle that situation. But what I'd always tell my clients was, hey, I'm going to keep your name and number because this isn't what I'm going to be doing forever. Someday I'm going to be doing real estate investments and I'm going to make you money. and I'm going to show you how I can make you money in real estate. And that was like my value proposition to people is I'm not taking money. I'm
That's
putting money in your
interesting.
pocket. And once I could create value in that sense, that gave me a very good sense of purpose. It gives me a good feeling of, what I'm doing on this planet is not necessarily bad. They say developers are awful, whatever, but all our
Right.
stuff's LEED
Right.
certified. We're doing green things, so anyway, those are my two little tidbits that I tell people.
So yeah, no, and those were two couple of really great and important tidbits. Actually, learning how to sell. I did not know, and I figured out in last 5-6 years that sales is the most important skill you can learn ever. And if you know how to sell, you can pretty much do anything. And second is creating value, giving more than what you are supposed to give, right? Providing enough value so that investors or anyone you are working with, comes back to you, right?
Yeah,
No,
for sure.
that's awesome. So thank you so much. How can my listeners reach out to you?
Well, promanas.com. Promanas rhymes with bananas, PROMANAS.com. And you can always shoot an email if you're interested in being on our potential investor list. We just have IR, investor relations, IR at promanas.com. And people can reach us there. There's probably some contact info in the book if anyone cares to download and read the book. I certainly appreciate that. I can honestly say I don't consider myself to be a real writer or author, but I think there's more than $20 worth of information in this thing. I don't know how much the book costs, honestly. It's probably like 10 or 15 bucks, but I think there's an awful lot of sort of value in it. I really tried to give everything I could, but those are probably the best places, email or website.
Thank you, John. I thoroughly enjoyed the podcast.
Yeah, thanks.
Appreciate it.
I appreciate you having me on. Thank you.
Thanks again. Have a great one.
All right, you too.
Bye.